Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. We're pleased to bring to you the special mid-year outlook series. On this episode and the next couple of them, we intend to discuss the macroeconomic outlook, asset allocation, and outlook for stocks, bonds, and currencies. On this one, we focus on the bigger picture view of the macroeconomy and asset allocation. At the start of the year, for many investors, a soft landing in the US looked like a mission improbable, if not a mission impossible. After all, about 6 months ago, the market consensus was calling for a global recession led by the US. The argument then was that the Fed was pursuing one of the fastest rate hiking cycles, which always pushed the US economy into a recession. At that time, we argued that a US recession was not a foregone conclusion and that our base case was for an asynchronous mid-cycle slowdown of the global economy. Halfway through the year, the Fed has indeed engaged in one of the fastest rate hiking cycles of the modern history, raising interest rates by a full 5 percentage points this cycle, and yet the US economy has not entered a recession. In fact, more recently, the US economic data has started to surprise the market consensus expectations on the upside. So what is going on? Well, the explanation lies in how this time is different. 3 sectors which were vulnerable to rising interest rates proved to be resilient this time around. First, on consumption, which is important for the US economy, pandemic-era excess savings meant that consumption trends remained strong even when the interest rates went up. Second, in the more cyclical housing sector, existing low-rate long-term mortgages played a key role in blunting the impact of interest rate hikes. Third, for the corporate sector, reduced leverage and falling share of short-term debt in the total debt stock reduced sectors' vulnerability. Of course, the Fed's long and variable lags did show up in the form of some of the largest bank failures in the US history. However, despite the gloom, the US recession has not happened yet. With this backdrop, what is the outlook now? Well, we continue to work with a mid-cycle slowdown and not a recession as our base case for the global economy. To that extent, we think investors should position and navigate a soft landing in the US over the next 6 months. We must admit that the risks and uncertainty around the US macro outlook remain elevated. Add to that the disappointing growth in China and falling services sector activity in Europe, risks become evident. Yet, in our view, a muddled through of the global economy is what investors should consider at this stage. Across regions, US exceptionalism has re-emerged thanks to the improvement in the growth inflation mix there. Led by domestic activity, Japanese economic momentum remains strong. It is in Europe that the economic momentum is fading at a time when both the European Central Bank and the Bank of England are strongly focused on fighting inflation. Turning to emerging markets, despite the disappointing China recovery, emerging market activity remains strong. In China, we do expect the policy support to arrive sooner rather than later, helping the broader emerging markets bloc. On inflation, in the absence of any major shock, the disinflation process should continue over the remainder of the year. Inflation could prove to be sticky in Europe, but in the US, inflation should continue to surprise on the downside. Admittedly, year-over-year comparisons are becoming less favorable for the US CPI. Despite concerns, we do not yet see tangible signs of a wage price spiral. Long-term inflation expectations remain well anchored too. Now, turning to the central bank policy, we believe that the Fed is close to being done with interest rate hikes for this cycle. However, we continue to see risks tilted towards a more hawkish Fed than to a more dovish Fed. To that extent, we do not rule out another 1 or 2 rate hikes from the US Federal Reserve. We do not see the rate cuts coming till second half of 2024. The European Central Bank and Bank of England have further tightening to do. Bank of Japan should turn hawkish later this year. Now, tying all this into our asset allocation, our strategy is to remain overweight equities and underweight fixed income. Equity sentiment has improved sharply, but positioning is still light. A further upside in equities is conditional on a revival in manufacturing activity and a strong earnings season. We expect both. After the recent move higher in yields, fixed income markets are now pricing in a better economic outlook and as a result, a more hawkish Fed. Yet the uncertainty about the timing of the first rate cut is likely to be a source of volatility in financial markets, especially for bonds. Against this backdrop, we would use alternatives as a way to diversify away our risks. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information regarding your asset allocation and how it needs to evolve, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. Please stay tuned for the next episode on which I will return to discuss the outlook for equities as an asset class.